Okay, it is 11 o'clock, so we can get going, I think. So, my guest this week is Matt Cable from Rights and Issues. So we'll be talking to him in a minute. But first, there is a lot of news to get through this week. So, 6 things that I've pulled out there, starting with Downing, which is from this morning. So, there's the chart. That's obviously taken from last night, so it's unaffected by this morning's news. Obviously, the discount is way too wide. We've been moaning about that for ages. The yield is very attractive. And it would have liked to have been an awful lot bigger than it is, but unfortunately, this discount widening started before it could get that done, despite the fact it's actually got a very good track record. So what we've got this morning is a bid for it by an outfit called Bagnall Energy, and it's a cash bid, so 102.6p, which is a decent premium to last night's closing price, but a 7.5% discount to the NAV after this dividend that's going to be payable on the 27th of June. Because obviously it's earning money and the NAV will be going up, if things aren't wrapped up by the 31st of August, there will be another 0.5p dividend before the deal goes through. So this looks like it's going to happen. Bagnall has already got a big stake in DORE. It's a fund that's advised by the same manager as DORE anyway, Downing LLP. So if you were trying to come in and compete with this, you'd have to have a sort of the suitable management team to try and take this away from them. And remember that they've got this specialist team running the hydropower assets that would be very hard to replicate, I think. So they are the natural manager of this thing. They've also got support from holders of another 16.8%, and the board recommending it. So this looks to me more or less like a done deal. Obviously, it would be nice to get closer to asset value, but this is where we are. The way it's structured, it's a scheme of arrangement. It needs 75% of shareholders to approve it, those voting. If it looks for whatever reason like that might be tricky, then Bagnall can switch to doing this via a takeover offer, like a normal takeover panel type takeover offer. And then it needs like 50% to take control. But as I say, it seems like this is going to go ahead anyway. I'm a bit miffed about it, to be honest, not because this isn't a great deal for shareholders, but generally because we've been moaning for ages. This is a great company, great management team, great track record. They've done everything they said they were going to do. There's no good reason why it's trading on such a big discount. It ought to have been trading at asset value and it ought to have been growing. And this is the next worst option, I guess. So it's just a real shame. Syncona next. This has been truly dreadful. And I should probably point out I'm a shareholder of Downing and also a shareholder of this one too, which is not one of my greatest investments. But there we go, on a 45% discount at the moment, and still a decent size after all that, because it was quite a big fund at the beginning. So it's now saying that it wants to adopt a managed wind down strategy with the aim of maximising value over the medium term. So obviously that means no new investments. They've got quite a lot of cash on the balance sheet. They want to support existing investments in the portfolio. Some of these, because a lot of these are cash consumptive companies that are trying to run clinical trials and things, they do need that money. There are some external investors that can help with that, but Syncona would like to follow its money and not get diluted. So all of that all makes sense. So there's no clue really as to what the size of the payment out of the existing cash pot might be, but there might be some. The wrinkle in all of this is this bit at the bottom. So they are talking about selling part of the portfolio at what would be a really chunky discount to NAV, from what they're saying there. A modest premium to the current share price, where this is a 45 discount and a discount to NAV. So this is massive destruction of value for the fund. And what really annoys me is the buyer of this. So they're talking about creating a new private investment vehicle to be managed by the existing manager, which may be spun out as a separate entity, and we're going to have to watch carefully to make sure that there aren't snouts in the trough around that. Institutional shareholders will be able to roll over their investment into it. External investors will be brought in too, and then it would be the entity that would buy the assets from Syncona. So they're basically, what they're doing is starting off the new fund with a great deal by buying assets at way bigger, way too big a discount to NAV, gives it an immediate uplift, which makes it look great from the off. everybody's wonderful, apart from small shareholders like me, like many others out there, who wouldn't be able to participate in this and would be missing out. So I think this is really bad news, and I will do what I can to oppose it. Henderson European, well, there's the chart for Henderson European, and you can see the uptick in the share price at the end, so they're very small there, down to 3 discount now. There's Fidelity European, and obviously the news is that the two of them are getting together. So in terms of the performance track records, there's not a huge amount in it, actually. I mean, obviously, Fidelity European has beaten over 10 years, but not by an enormous amount. BlackRock Great Europe is actually ahead of it. But still, if you are Henderson and you're looking for a merger partner, then it's not a bad option. I think actually probably a very good option. The history of all this, how this has come about. So we go all the way back to 2023. So Henderson had 2 European funds, one of which was Henderson European Focus. John Bennett, who's a very well-regarded manager of that fund, decided to retire. He'd been running for 13 years. He'd been veteran in the industry for more than 40. And so that's created some unease amongst shareholders. So Henderson decided the best thing to do was to knock together the 2 European funds, and the boards agreed to do that. So that was announced in March, but they actually needed to sweeten the merger terms of that in May to actually get the deal across the line. And then it ended up with this enlarged fund being run by Tom O'Hara and Jamie Ross. And then in February, it turned out that they were leaving Janus Henderson, and obviously that was a big blow, and the board were understandably upset. So they immediately launched a strategic review, and the outcome of that is the merger with Fidelity European. In terms of the practicalities of this, it's a normal Section 110 scheme. We've talked about these a number of times. There's been a lot of them now. Fidelity is the one absorbing Henderson European. There is a cash alternative, and it's really quite generous. So it's a third of the trust, 33.3% of the trust, at formula asset value, which is NAV less the costs, less 1.75%. So I think that's actually not a bad deal. If you want cash, then go for it. You might end up getting out more or less at the current discount, I would have thought. Although you could, if you wanted to, try rolling your money and then selling Fidelity European, but I think probably you want to the cash box if you want out. Even if that gets taken up in full, and I don't think there's any guarantee that it will do, but if it does get taken up in full, this trust is still going to have more than £2 billion worth of assets. So it will be a proper champion for the sector in Europe. Run by the same team at Fidelity that have been running the fund forever now, Sam Moss. And there is a deal with the manager to inject money via a fee waiver to cover a lot of the costs. So they're saying about 2.4 million quid, which translates into covering all of Fidelity European's costs, as you might expect, and then some of Henderson European's. We don't know what those are going to be. They've already got 33% of head shareholders saying, yes, we want to do this. So again, I think this looks like a done deal. And I think this looks like a good option. The new fee arrangements, they are cutting the fee. Again, this is good news. In the sense it's a new tiered fee. That sort of 400 million tier looks a bit redundant now, but there we go. And it could be done quite quickly. So they're talking about meetings in September and wraps up by the end of September. So as I say, this will almost definitely happen. Gore Street Energy Storage next. Again, we know the whole story of this and the way that the discount widened out, and the fact it's been narrowing a bit more recently, which is good, but still way, way, way too wide, and that means it's on a high yield. They've just published a new NAV, and that wasn't great. A lot of these funds, a lot of the new energy funds, are still seeing a hit from power prices, and they do feed through a bit into battery revenues as well, because if you're basically trying to arbitrage the swings in power prices and the top end of that is coming down, that does reduce your sort of available income. So they're saying that's going to take about 6p off the NAV. But because they brought a lot of assets online and they were valued on a discount rate that reflected the construction risk, the new discount rates would be lower than that, and that lifts the NAV up. So we did see an offsetting gain from discount rate movements. In terms of dividends, so if you remember, it's been paying a penny a quarter, then it said it would pay more if it got the investment tax credit money in from the 2 US battery storage projects that have been brought online. So it's had the Dogfish money already. The Big Rock money is still coming, and they're saying it looks like it's going to be top end of the range, which I think is about $50 million plus. So they're going to use some of that to pay a 3p dividend. So that basically means we get 7p for the year, which is good news. But they're saying that going forward, the dividend is going to be more reflective of what the company's earning, which makes much more sense. So you won't have this sort of an NAV sort of chipping away thing. Also helps, you're going to have the lower fees because they're shifting to this 50-50 NAV market cap basis, which some of the other renewable funds have done, which is all right, but I don't see why they don't go the whole hog, but there we go. There's no performance fee anymore. You probably didn't know there was a performance fee because I don't think there earned one, but there we go. And it's still 12 months notice in terms of having to fire the manager, but there's no termination payment in the event of a takeover. Given what's going on, and Harmony, and now Downing Renewables and all this other thing, yeah, that's not completely out of bounds. So the fee saving is well over £1 million a year, assuming the discount doesn't narrow. Obviously, the discount narrows, then that disappears. But that's still quite useful and will help towards the income. So they're going to use what's left over from the cash to from Big Rock to pay down the debt, and they're just going to sort of sit on lower debt for a while they talk to shareholders about what should happen. They've brought in an external advisor to look at the pipeline of assets that they've got. So they'll be weighing up how much money can we earn out of those versus how much is the benefit of buyback stock. That's more or less the calculation they'll be doing. But they're also going to be looking at the sort of more strategic options, things like should we do a merger, should we dispose of part of the portfolio, should we do tenders, all that sort of thing. So the story is not finished yet. There's more to come. It's going to be interesting to see what happens. I do think their dividend is more or less likely to fall from here. I do not have much clue of what value you can really put on the US pipeline, given what's going on with Trump and this sort of rolling back from the Inflation Reduction Act stuff that Biden had. I think it might be harder to monetize those things, but they've got plenty of other opportunities elsewhere. And Hansa Ocean Wilson's next. So Hansa's not a massive company, 300 million market cap together. The odd thing about it is it's got voting shares and non-voting shares. The voting shares are all controlled by the Salomon family. That makes it bid-proof. They don't seem much bothered about the discount. That's the reason why the discount is enormous. They're also not much bothered about getting an income, so the yield isn't very high either. So I've never been a particular fan of it. It's had a stake in Ocean Wilson's for a very long time. And Ocean Wilson is it's an investment company, but not an investment trust. It doesn't have that kind of tax advantages. And it's got a very similar portfolio to Hansa, apart from the fact it used to have this big investment in a Brazilian ports and logistics business. That got sold, and that actually deal completed on the 4th of June. So that means that Ocean Wilson's is quite cashed up. It's going to using some of that cash to do a 20% tender for its stock, and that's like a reverse stock auction. I think we might have talked about this before. So once that's done, it'll look a lot more like the Hansa portfolio, but we're still with some cash, I think. So they're going to knock the two together. The idea is they're issuing voting and non-voting shares, which I thought was a surprise. But actually, there are kind of insiders on both sides of the trade. It's done on the basis of formula asset values, so NAV less cost of the transaction. That's all you get calculated at the end of the month. It's all been done at Bermudan law because they shifted the domicile to Bermuda, which I think was a way of making sure they never had a problem with somebody coming in and saying you can't have non-voting shares. So I think, again, this is a done deal, really. They are cutting the fee, which is good. There's a concession to that. And that's reasonably chunky because it was 1%, and it's going down to 0.8 and 0.7. And the other thing they're doing is they're saying they're going to buy back between 2 and 4% of the shares each year. I don't think that's going to make any difference to the discount. And the share price of the non-voting rather, has jumped a bit this week, which is good. But I can't see any other catalyst to get this going, really. So I wouldn't be piling in. Lastly on here, MIGO Opportunities. Obviously not very big, but very well liked. Trading on ready metallic discount because they've got a discount control mechanism. But it's really synonymous with Nick Greenwood, and he's been running for many, many years. He's been running with Charlotte for a long time too. She's going to stay on as co-manager as Nick moves into a consultant role at AVI. And Tom Trainer, who we know from AVI Global, is going to become co-manager with her. In conjunction with that change, they're going to kind of shift the investment approach. So they're going to have a much more concentrated portfolio of things that they are trading on B discounts where they think they can influence boards to get that discount down. So it's becoming a much more openly activist fund than it was. They don't want any kind of comparison with Saba, and I understand that. And so, commendably, they've said, to avoid any accusation that we're going to be asset gathering, actually meaning in there, we're going to basically hand back assets above 150 million to you via tender offers or dividends or whatever they can. And they're also going to have a regular 3-yearly exit opportunity that they're going to maintain an existing structure. So that will help keep the discount down too. They are cutting the fee, but they're introducing a performance fee at the same time. So again, this is all about incentivizing the manager to achieve decent returns. And the hurdle rate that they've set themselves is SONIA, which is the equivalent of LIBOR, plus 3% per annum. So if they earn more than that in a year, they'll get 15% of the excess will go to the manager. But the fees are capped at 2.5% each year. So with the normal market, normal base fee plus the performance fee can't be more than 2.5% each year. And quarter of that money, the performance fee money, will be reinvested into the shares. So this all makes sense to me. It's quite a good outcome, I think. There's a kind of parallel because basically, if you think about AVI Global, it's got holdings in investment companies, a bit like MIGO. It's got holdings in Japan, a bit like AVI Japan. But AVI Japan, because it's smaller, can hold smaller companies. And the same thing here with MIGO. Because MIGO is smaller, it can hold smaller companies than AVI Global can. So sometimes there'll be an overlap in the portfolio. Sometimes it'll be stuff that only MIGO can really afford to do. That all makes sense too. And I thought, because these are all now presumably in play, these are the ones that it's currently got big holdings in. Christis, we know, is also the biggest holding, I think, or one of the biggest holdings in AVI Global. And obviously there's stuff going on there. When if they ever get Klarna IPO done, there'll be cash returns, hopefully, and all that sort of stuff. And then, they've got this ongoing capital management policy, and we are working with them trying to drive the discount down, which is good. PRS REIT is almost a done deal. So that's always been some takeover offer. There's plenty of other stuff on there. VH Global's already implemented and managed wind down. Oakley is hopefully any minute now shifting its main listing from the specialist fund segment to the main market, and I think that will make a big difference to its rating. Credit European News is already in wind down. So too is Spring Spray. Basically all of these things is very interesting stuff. Watch what happens within this top 10 because that will tell you where they're going off to next. So I've run over way more than I normally do.